to the fourth Gold Weekly. We haven't spoken to you for a fortnight. Not really a lot to talk about. The gold price has been consolidating around $12.50. It's in this tight pattern, almost in balance between demand and supply. And as we mentioned to you before, once it breaks out of this, it's going to make a very, very strong move. The Golden Cross is still in position. That means that the 50-day average has moved through the 200-day average. It's a very positive signal for the market, a technical signal, as they call it. It describes the mood of the buyers and sellers. So it remains positive, but almost inactive. But there have been events which have surprised everybody. We've watched the Fed. We mentioned their comments last time we spoke to you. But in the last week, we had Mario Draghi of the ECB reflecting the same less dovish mood as Janet Yellen. But in his case, it's quite a different matter because Europe has been viewed as negatively for quite some time. Fears of the French pushing for a Frexit after the Brexit. The Italians getting unhappy and maybe wanting to move out of the EU. All sorts of fears in Europe. And then Mario Draghi mentioned that if things keep going the way they're going, they will probably move away from the stimuli they've got in place at the moment. Probably reduce it on a monthly basis. But it's reassuring everybody that rates will remain low for a long time. But that change of mood, that inflection, was enough to make the euro go much stronger. In fact, it's now broken through 114, and it did so quite quickly in the last 2 weeks, and it's looking very bullish. If it goes through 170, there's very little above it to stop it rising right back up, and its peak at one point was $1.40 for each euro. Meanwhile, the dollar itself has fallen back quite strongly, and it looks as though it's about to enter into a bear market. The dollar index is showing a level of 95. Well, if it goes below that into the 94 area, it looks as though it's confirmed a dollar bear market. The other market that went into a bear phase is the oil market. The United States shale producers have produced so much oil that they've really rather negated OPEC's oil cuts, and the result is the oil price is down in the mid-40s, both Brent and the American oil price, West Texas. We look across back at the gold market and we see that Russia has bought again quite a large amount, 21.8 tons in May, having bought nothing the month before. But in Russia's case, you look at the longer term. But the important thing we took from that is Russia is a continuous buyer. We believe China is too, but they're not declaring the purchases they make. And indeed, they don't have to. They can buy it through agents such as SAFE and CCEC, as well as buying it through the Shanghai Gold Exchange. The market there, as we mentioned last week, is less volatile and it's completely physical. COMEX in London, bulk of paper trades, and as we again mentioned, 90% of gold transactions, or described as gold transactions, take place through London, New York, but they're what we call paper transactions. We believe that about 80% of global physical transactions take place through Shanghai, but it's not coming through in the price yet, but it will in time. What we can say about the Western gold markets is that the central banks are quite content with the amounts of gold they have at the moment. But that's not the point. The point is they stopped selling in 2009. Russia and China are buyers, strong buyers, heavy buyers, and there's a massive shift of gold out of the West into the East. So clearly the central banks may be content, but they certainly won't sell. They know it'll be snapped up by these Asian banks. A dramatic event during the week which is the story of great interest to everybody, is a sale first thing Monday morning, one shot, 56 tons of gold, but it was sold through the futures market. So it wasn't gold, it was simply a financial transaction related to gold to the extent of 56 tons. If that had been physical, the gold price would have been falling like a stone. But it wasn't, and it bounced back within the next couple of days, which is the point about such speculation that is not actually gold related. Sorry, gold, not physical gold, being gold related. If they'd sold the same amount of pork bellies, it doesn't mean to say people are selling that many pigs. It's a financial transaction with reference to the price of the commodity mentioned. Now, in this case, the 56 tons, some thought it was just getting an options position right on COMEX, so do it through London, so sort of arbitrage between the two markets. But others, and we tend to go with this story, is what they call the fat finger. When you want to press a particular button, your finger's so big it presses the next button as well. Now, what they could have done is to intend to sell over 18,000 ounces of gold, but instead they sold 18,000 lots of gold, which is 100 times bigger, so hence the massive amount. But the price came back pretty quickly, which tells us it was a speculative move, accidental or otherwise, and did not relate to the gold price, which is why the gold price is still around 1250, just below at the moment. It's nothing for us to be concerned about, but it did teach us certain lessons. The first lesson was Shanghai ignored it. The prices just continued to rise. London and New York panicked. The dealers pulled back the prices, and what I mean by that is they didn't sell, they simply marked prices down in fear of sales. If you think somebody's going to come and sell you a car for 50,000 and you don't actually want it on your stock, you'll offer him 40,000. Same with a dealer in the London market. They've dropped the prices, but there's no actual sale going on. It's not a spoof, it is actually simply dealer maneuvering. And we expect to see that every time there's this sort of action going on. We also learned that if you want to impact the gold price permanently, you have to sell physical. By example, I go back to 2013, when 400 tons of gold was sold from Goldman Sachs and their clients at a time when the gold price was about $14.50, and that knocked the price back nearly $300 plus. But this year, on balance, we've seen the US buying physical gold. Not a great deal, and certainly not to the extent. It's around about 250 tons in the last year, around about just over 50 tons in 2017. Not really enough to break the gold price upwards. So those three lessons: Shanghai not affected, physical sales needed, and dealer positioning. But now we keep mentioning the pricing power of Shanghai. Why do we do that? It's because if pricing powers in Shanghai where volatility is being squashed, then we'll see far less volatility in the future. If pricing power lies with New York, you'll see a very volatile market. The next point we learn from it is the direction of the price. In China, where middle classes are burgeoning, the traditional investment is gold, and the Chinese will be buying more and more gold on a continuous basis as they get richer, as the middle classes grow in number. So that's a tremendous pressure under the gold price over time. But for it to impact on the gold price, it has to break through the margins, the small amounts that trigger a price change. And the next thing we learn with pricing power is if you're what London has called the premium, what I call the discount of London to Shanghai as opposed to Shanghai to London, if that difference is, let's say, over $10, over two figures, you will see this constant pressure to buy in London and sell in Shanghai. It won't come back because gold is not allowed out of China. But so long as that difference is large, you're seeing this seepage of gold from the west to the east. Fascinating market, and we think it's going to get a lot of attention in the next weeks and months, certainly years. And we see gold moving back as a reserve asset into the center of the global financial system, a place that has been denied since the turn of the century. Enjoy your week. Look forward to speaking to you again. Goodbye.